You saved for decades, built a 3 million portfolio, and still feel nervous about spending, and you're unsure what kind of life it can actually provide for you. Because maybe you're checking your accounts, late at night and refreshing the values once again just to make sure it's still enough. But if you don't get clear on what you can spend, you risk oversaving, overpaying in taxes, and missing your window to live generously. This video walks you through exactly how much you can afford to spend and why a big balance alone hasn't made you feel safe. And my goal by the end is you'll finally be able to stop second guessing, start spending with purpose, and enter retirement with the confidence to actually enjoy it. Because what if the real risk in retirement isn't spending too much, but spending too little? See, most people assume overspending is the danger, but what if the opposite is way more common? For example, if this couple with 3 million in investments in a classic 60/40 portfolio limited themselves to just spending 4% of their portfolio each year adjusted for inflation, backtests show there is over 53% of instances where they would die with more money than they started. Now, most people follow this 4% rule because they are afraid to overspend. Because even with strong portfolios, many people live with a scarcity mindset, right? There's a fear that a market downturn, a medical event, or an unexpected cost could ruin everything. So they play it safe. They stick to their conservative rules and defer spending, just in case of those 10% chances. And often this mindset comes from years of accumulation mode, right? You've been taught to save, and then save some more for good measure. And when the time comes to spend, it doesn't feel natural. The default in retirement is to underlive your potential just to feel secure, but the data tells a different story. So take Jeff, age 66, and Carol, age 64, as an example. Their goal was to retire now. They have an investment portfolio of 1.3 million in a joint brokerage account, with about half that account being basis, 700,000 in Jeff's 401k, and $1 million in Carol's rollover IRA. In the projection we will look at, we are assuming a moderate growth investment strategy of about 2.3% returns net of inflation in the first 10 years and around 7% returns net of inflation over the remainder of retirement, right? This is no guarantee, just an assumption backed by historical data. Now, I'll get into more of their plan specifics in just a moment, but based on what they thought they could spend, in every single one of the thousands of simulations we ran, their lifetime experience would be above planned. And in 0 cases, it would be below. They weren't just okay, they were dramatically underspending and unknowingly sacrificing joy and freedom. This isn't just about missed vacations or nicer restaurants. It's about quality of life, about taking the grandkids to Disney while you still have the energy, about, saying yes to opportunities without guilt. So the real risk isn't overspending, it's missing the window to live fully while you can, and that window doesn't stay open forever. Now, Jeff and Carol had a number in mind that felt comfortable, but what made it feel safe in the first place? And was that number actually grounded in risk? Well, they assumed they could spend $7,000 a month on core living expenses to maintain their current lifestyle. In addition, they wanted to spend $24,000 for travel over the next 15 years while they still have their health and they could take overseas trips. And they wanted to keep giving at about $18,000 a year. Now, Carol will have 1 year of pre-Medicare insurance premiums at $800 a month, so that's an extra expense we needed to account for. Now, adding all that up, that's around $135,000 per year, which is about 4.5% of their portfolio total, which sounded reasonable. Of course, this is before we consider taxes, but to them, they thought it would work. This all seemed to fall in line with traditional rules of thumb. But here's the thing, they weren't actually tracking what was truly coming from their portfolio. They were focused on the total spending number. And that's because they weren't sure how to account for things like Social Security, when benefits may not start right away, and you need to lean on the portfolio to create all the income until benefits kick in later. And when we dug in deeper, we found they were on track to only withdraw about 2% from their portfolio. They were limiting their potential simply because of a desire to stay conservative. And in reality, they were leaving a ton of lifestyle on the table without realizing it. So while the $7,000 a month target plus all their other expenses felt safe, it wasn't based on risk or reality, it was based on an assumption. And assumptions left unchecked can lead to decades of under-living. Now, if you're thinking, well, isn't that better than the alternative? Let me ask you this. Would you rather adjust your spending down by, say, $500 a month when things don't go as planned, or live 30 years with regret about what you didn't do? And that's because most people think of retirement income as a single stream, but understanding the sources and the timing is the key to feeling confident in your plan. Jeff and Carol assumed they'd be drawing evenly from their accounts, but they didn't map out where the dollars were really coming from. Because in reality, year one of retirement looked like this. So Carol would start Social Security early, and the rest comes from their brokerage account. So then in year two and beyond, the withdrawals from their portfolio dropped dramatically to that 2% figure I mentioned earlier. And because of how long-term capital gains and standard deductions work, they would pay almost no federal tax in that first year. So their retirement paycheck wasn't just $12,200 a month, it was $12,200 a month with virtually zero tax drag. So to summarize this all, they could meet all their expenses after taxes have been considered, and in the first month of retirement, they would have Carol's Social Security benefit and would take about $9,200 from their brokerage account. So their needs are met, and this is a good plan. But what happens when you optimize both income sources and tax strategy? In other words, how much could they actually spend? Because the numbers might surprise you. You might recall in the initial projection, we showed they could spend around $12,200 a month, which would meet all their lifestyle expenses and tax needs. It was a good plan, but was it a great plan? So instead of asking, can we spend this? Instead, we asked, what can we spend? And a whole new world is unlocked. Now, as we can see here, in reality, they could spend closer to $17,200 a month. That's $5,000 a month more than they were thinking. Now, if you're wondering how that's possible, let's look at the numbers. So as we can see here, after rerunning their numbers with a more dynamic approach, it turned out Jeff and Carol could spend $194,000 in their first year from their brokerage account. And as Jeff's Social Security kicked in later, their need to draw from the portfolio drops. And if we follow what the academic research shows, which is that most people spend more early in retirement, less towards the middle, and increase towards the end of life, they unlock a whole new world of opportunity. Because not only could they spend more now, they could do it with confidence that in future years, it wouldn't require a massive course correction. The projection isn't just a snapshot assuming the same spending and rates of return throughout retirement. It's accounting for the natural ebbs and flows of retirement. And that's because retirement isn't static, right? So spending shifts, there's going to be income shifts, life happens. So if your plan only works in year one, it doesn't really work. You need a plan that adapts and considers all income sources, the timing, and the adjustments you'll likely make along the way. Now, even with the higher spending, their plan still showed a 99% success rate of income being above planned over their lifetime. So instead of hoping they were spending the right amount, they could finally see it and, more importantly, trust it. They can stop asking, can we afford it? And can start asking, is this the life we want to live? But let's stress test the plan, because even with these numbers in mind, you still might be asking, but what if the market crashes? Would they need to slash this higher spending? Because Jeff and Carol had dynamic income guardrails in place, their plan could flex with an unknown retirement. So the plan didn't assume perfect straight line returns. It plans for volatility, and it shows them exactly how much their income would need to change, if at all. So even if their portfolio were to drop by about 45%, their income would only need to be cut by about $600 a month. See, this is a minor tweak. It's not a lifestyle disruption. But we can take this one step further and model their plan with this higher spending amount against some of the worst periods in history, such as the '08 financial crisis. And so as we can see here, their plan holds up very well. It wouldn't necessarily be stress-free, but this allows them to spend boldly, knowing exactly when and how to pull back if needed. And if the downturn never came, even better. This is the power of proactive planning, right? It turns the question from what if the market drops to, okay, here's how we're going to respond. Because downturns are inevitable, but with the right strategy, they don't have to be disastrous. And knowing you have a system in place takes the emotion out of decision making. It keeps you from overreacting and gives you permission to stay the course. Now, what many people don't realize is that playing it safe has a price too. Now, again, we could assume some linear projection on their returns over their lifetime, but that's not entirely realistic because when you earn those returns in retirement matters. But as we will see here, if they play it safe and spend less than they could, the median scenario is that they would end their life with around $2.5 million in today's dollars. And there are some instances where they would die with over $6 million. Of course, this excludes the value of their home, so they are leaving a lot of money on the table. But in the optimized income plan, the median scenario is about $1 million. But more importantly, look at how the best case scenario is more reasonable at $2.5 million. See, most people we work with aren't interested in leaving a bigger balance behind just for the sake of it. They want to enjoy life with the people they love while they are still alive, to spend time together, to share their values, and pass on wisdom before wealth. Too many people operate under a scarcity mindset even when abundance is possible, and that mindset costs them more than they realize. So yes, play it smart, but don't confuse caution with wisdom. See, true wisdom is using your resources with intention and well thought out plans supported by data. Now, most people focus on spending or saving, but what if tax strategy is the key to unlocking both of those things? So to take Jeff and Carol's optimized income plan even further, if they stuck with the default order of withdrawals, so taxable first and then IRAs, they'd avoid taxes now, but it will create a massive tax bill later. Their IRAs would balloon, their RMDs would spike, and they'd lose control over how much they owed. So instead, by strategically converting pre-tax dollars to Roth up to the 12% bracket, you'll see here they smoothed out their tax curve and avoided future spikes. And that one decision reduced their lifetime taxes by $334,000 adjusted for inflation. And just as good, it increased their total lifetime net income by the same amount. And it didn't require anything radical, just proactive planning aligned with their goals. And this is the value of holistic financial advice. See, not answering, can we retire, but showing you how to retire better, with more flexibility, with more generosity. Because the goal isn't just about how to lower your tax bill, it's to create space in your plan. So the space for freedom, for giving, for margin. So yes, the numbers matter, but they're not the end goal. The real win is aligning your money with your purpose. So what does that look like for you? For Jeff and Carol, they wanted more time with family and more travel and more giving. They could afford to spend more, but the question wasn't just how much, it was why. For them, it meant bigger family trips, more support for missionaries, and the freedom to say yes without guilt. And maybe for you, it means something else. Maybe it's retiring sooner or helping the kids. The beauty of good retirement planning isn't just math. It's clarity about what matters most and the confidence to live it out before that window closes. Because in the end, the most valuable asset isn't your portfolio, it's your life you want to live in the time you have left. So let's make sure you're spending both wisely. But now that you've seen how even a 3 million portfolio can leave you feeling uncertain about what you can spend, so what actually changes if you have 5 million instead? And what doesn't change even when the numbers double? I want you to check out this next video where we compare 2.5 million to 5 million retirement plans side by side and uncover why more money brings more choices, but it also brings more complexity. I'll see you over in that video right now.